All right, welcome to the business news. And economic watchers and everyone with any sort of debt will be watching the rate announcement this week. The repo rate is the benchmark interest rate at which the Reserve Bank lends out to commercial banks, and it is expected to rise again on Thursday. Of course, commercial banks then follow suit, causing the prime lending rate, which affects most of us as consumers, to climb higher. So let me show you where we are right now, and this graph is interesting because you can see that when COVID hit in 2020, the prime lending rate was hovering at around 10%. And in a weaker economy, of course, rates often come down. The effect is that consumers have less to pay on debt, more money in their pockets. So prime fell all the way down to 7%, and it's been a great ride for consumers, but it's been ticking upwards and it's now edging towards 8%. So with rates rising around the world while economic growth isn't booming, the question is, can consumers keep up with their payments? All right, and what about the housing market? When rates were lower, of course, it made paying off a house much cheaper. That resulted in more purchases of property, especially for first-time homeowners. Some homeowners were also inspired by the lockdown, of course, to upgrade to larger homes, more spacious homes. The growth in house prices has, in fact, been significant. Rather, in-house purchases has been significant, but in terms of prices, not always keeping up with inflation. So to discuss, we're now joined by business journalist Ray Mahlaka. And Ray, great to have you with us. What effect will a 50 basis points interest rate hike have? That's what some economists are talking about on Thursday.
Well, we do know that in theory, rising interest rates tend to make life more unaffordable for consumers. It makes, their debt much more expensive. So in theory, we know that a rate rising cycle tends to dampen consumer spending. So that might put off a lot of potential home buyers off from entering the housing market because, as you said in your throw forward, Francis, interest rates might rise on Thursday. Inflation is rising, which we know that the cost of living is becoming more expensive, as seen in petrol price hikes and also food price hikes as well. So overall, the consumer is being squeezed. So an interest rate rising environment tends to make consumers buckle down and not really have the appetite to take on more debt. And that's the impact that is expected as interest rates are set to rise in the next coming months.
Yeah, unless they want to be risky and potentially get into trouble down the line. So we know, Ray, that unemployment is huge in South Africa, but people who are in jobs have been pretty resilient. Some have even reduced their debt. Are there huge concerns about the ability of consumers to handle another 50% basis hike?
Well, very interesting. Today, FNB, a bank, released some interesting data. It says that the middle class, we're talking about people who earn between 150,000 Rand to 800,000 Rand per annum, once they receive their salaries, they spend about 80% of their salaries within 5 days, and the remaining 20% of their salaries they spend within 20 days in order to survive. So we are seeing the squeeze now starting to come through for the so-called middle class, consumers. Again, petrol price increases, that tends to feed food prices, that feeds higher transport costs as well. And you add on higher interest rates, and that adds a lot of pressure, among consumers as well. So we are seeing a bit of strain coming through from, regarding consumers, as seen in those FNB statistics that I quoted much earlier.
Yeah, and let's remember that your house costs go up, and of course your car payments go up, so that 20 days could get even longer for some consumers. Ray, let's just wrap up what's been happening in the property market. You call it a pandemic-inspired housing boom. So there's been lots of buying, but we still call it a buyer's market because sometimes the prices don't go up, or they certainly don't go up in line with inflation. So you're even losing value as a homeowner often. I guess it depends where you are in the market.
Yeah, well, industry players call it a buyer's market at the moment because there are two points. The first is that if you look at the appetite of banks to lend money to consumers, that appetite remains high. In fact, competition among banks is so fierce to get customers that they are willing to give out mortgage loans of about 100% to consumers, loans that don't require any deposit from a consumer. So that on its own creates quite a favorable market for consumers to get debt to enter the housing market. The second point is, if you look at who's buying properties right now, it is first-time home buyers because of low interest rates. The repo rate or the prime lending rate is still at about 7%, which is still quite low compared with historical standards. I mean, before the COVID pandemic started, the repo rate was sitting at about 10%. And if you look at who are the biggest buyers of property currently, it is women. It is single women who are entering the housing market. So those low interest rates have boosted and enabled first-time home buyers to enter the housing market.
So Ray, let me stop you there. And I guess, that could be the effect. We could finally see those first-time buyers also being reluctant, feeling the pinch, but good on those women getting into the market. The reality is here, you have to look at what you can afford now and what you can afford in the future, given the perception that rates will keep on rising. All right, thank you very much, Ray Mahlaka, business journalist